Welcome. I'm Professor Daniel Sokol of the USC Marshall School of Business. Today, I'm pleased to introduce the moderator of our panel, trying to understand how the venture capital ecosystem addresses questions of exit. Our moderator is Kelly Fayne, a partner in Latham's San Francisco office, where she focuses her work on antitrust, both in terms of deals and all kinds of conduct, where she intimately understands the needs of venture capital, private equity, and the entire venture capital ecosystem of companies that she both helps bring to market and also helps to exit the market. Kelly?
Thanks, Danny. So I'm pleased to be with all of you, and I'm pleased to introduce our first panel, which is titled Venture Capital Investment in a Complex Regulatory Environment. I come to this from the perspective of an antitrust practitioner, having helped a number of companies navigate what has been an extremely complex regulatory environment in the US, especially with the last 4 years of the Biden administration antitrust, but well beyond the US in across Europe and in Asia and elsewhere, kind of increasing regulatory attention, especially around the tech industry. As the technology industry kind of enters a new phase of disruption and innovation, especially around AI, we are revisiting some of the same age-old questions in antitrust and in other areas, which is what makes a company innovative, what drives investment in innovation, what drives somebody with a good idea to start a company and help it to grow, and what drives some of the larger players in the technology landscape and beyond to think about acquisitions and mergers, or just other investment framework. So with that context, I'm extremely pleased to introduce our three panelists. In no particular order, Vivian Chang, who is a graduate of the USC Marshall School of Business, is also a partner at the venture capital firm Next 47 in Palo Alto. And she's got over a decade of experience in the tech industry and has served as both an operator and a venture investor. Next to her is Ian Park. He is, in addition to being named by Venture Capital Journal's one of their 2024 Rising Stars, which makes me feel old, Ian Park is a partner at the venture capital firm Primer Sazze, and he invests and works to build successful businesses in the US and in Korea. Finally, I'd like to introduce Choi. He's an entrepreneur, a seed investor, and an international venture capitalist with startup and multinational corporate experience. He's also the founder and managing partner of Tekton Ventures. So I am going to invite this panel to weigh in on a number of questions and talk with each other about how they see venture capital investment and how they see the regulatory environment. So let me begin with maybe a little bit of an icebreaker. I'd like to know very much from each of you how you approach investments, what your primary considerations are when you're thinking about a new investment, and how you decide where your capital is best deployed. And why don't we start with Vivian, who is the furthest on my right and the one person I can see behind my notes at the moment.
Awesome. So I work at a firm called Next 47. And just to kind of, it's really like the firm's thesis that also informs my own personal investment strategy. We're a $2 billion fund, primarily leading rounds Series A to Series C. So really stage focused on, post-seed investing. Our check sizes really range from 10 to 30 million. And I think like most lead venture firms, we're trying to, take high ownership, high conviction positions in, call it 12 to 15 deals a year. And really ownership targets range from that 15 to 20%. I would say thesis wise, we are solely a enterprise focused firm. So anything application layer, infrastructure layer, anything kind of selling to an end business user is our focus. And kind of along with that, we have an internal go-to-market team that really helps our portfolio close deals. And again, really specialized in enterprise deals, primarily, think Fortune 500 or mid-market tech. So we think this is a pretty differentiated way to approach the market, whether, think of it almost like an AE for hire for a lot of our portfolio. I personally focus quite a lot on what I like to call the application layer. These days, apps and infra are quite blended, especially in this AI world. But again, focused primarily on thinking through, really the crux of venture is finding really special teams to back on tackling big problems. I will say the firm is quite bent on, AI these days, whether that's, thesis wise in the form of labor replacement has been a popular one. Where can we automate a lot of labor? Where, enterprises and businesses have traditionally had a lot of BPO spend or where there's labor shortages in the market. To give an example, we've been quite focused on, the accountant shortage or folks in tax. I think there's a lot of different shortages across vertical segments that we've been quite excited about. I would say the other thesis I've been pursuing is how to unseat a lot of existing systems of record. And we think AI kind of presents the first time in a very long time to unseat a lot of these, systems of record. And so I think hopefully that gives a good sense of how we, thesis wise and stage wise, like what I'm interested and focused on. Really other primary considerations is, I think in this world where we're seeing a lot of great teams in the AI hype cycle go out to start something new, really thinking more about people and product and defensibility kind of more than ever. Happy to dive into more of those, but I think hopefully that was a good overview.
That's a great overview, and thank you so much. And I'm sure we'll come back to a number of these. Why don't we go to Ian next?
Hi, my name is Ian Park. As Kelly said, I'm the partner at Primary Sazze Partners. We invest in Korea and also in the US, about 6% in Korea, 40% in the US. And we focus on more Korean American founders because we think those companies are undervalued. We have some numbers and proofs there. We are very early, pre-seed and seed companies, less than $20 million valuation. We try to get about 30 to 50 companies per fund. Our AUM is just over $200 million. We're starting, we are working on a bigger fund right now. And yeah, we usually focus on two big sectors. One is B2C, and the other side is deep tech, which we think has a really good tailwind for Korean founders. B2C stuff, K-pop, K-beauty, those are the things that we're really excited about. And we are also really excited about AI-based, more B2C apps. And also the other side of the table is we do a lot of deep tech investment, semiconductors, of course, and robotics and bio. Those are three major strengths that we think Korea can do better than other countries. So that's what we're really excited about. Stage-wise, again, pre-seed and seed, we care a lot about the founder and the team. As you know, we invest in really early, so we don't really see the numbers. So we try to figure out what type of person this is, why he or she's doing this. That's most of the thesis that we start with. And yeah, happy to be here.
Great, thank you so much. So Jay, over to you.
Okay, great. Nice to meet everyone. So Tekton Ventures was started about 15 years ago by my partners and I. We all come from a multi-generational fund called Partech, which is a pretty active multi-stage fund now, really based out of Paris, manages about just over $3 billion. We started Tekton a little bit differently 15 years ago, really to go much earlier in the venture cycle, similar to what Ian mentioned at the pre-seed and seed. But we also wanted to take our long history of being either founders or early stage investors from Silicon Valley and really apply it towards some of the best entrepreneurs globally. And so we started to invest back in 2010. And I'll share a little story of how our models evolved. One of our first investments was in a home country in Korea, where we found an entrepreneur that was building essentially an Amazon equivalent in Korea. And that company was called Coupang. And we seeded that company in the very first seed round and stayed in that company since the IPO. It's a New York listed traded company, multi-billion dollars now. But our thesis has really evolved from that since then to really, we believe that Silicon Valley still is the innovation hub of the world. And we think that there's other innovations of the world, parts of the world that are capturing that same level of excitement around entrepreneurs. So we have a fund that actually is an evergreen structure. We don't have outside LPs. We do two things now. We use our own principal capital that's backed by the GPs, and we invest at at inception into the very best entrepreneurs globally. And we actually invest in two things. We either invest in technology-driven founders around the globe, whether it be Silicon Valley or throughout Asia, Europe, Latham. We're very global in scope. And then we also invest in founders who happen to be venture capitalists that are spinning out or emerging managers. So we started this about 13, 14 years ago. So we've invested since then in about 200 plus companies in over 25 different countries around the globe in great entrepreneurs, as well as over 50 to 60 managers as LPs. And what that does is it allows us to have a very ecosystem-driven approach to investing in the very best entrepreneurs and the very best investors that are spinning out and also becoming the emerged next generation managers that we love to collaborate with. When you leverage this as almost an ecosystem approach to investing in venture at the seed globally oriented stage. So we're based out of San Francisco, where we continue to be very active, and but we invest across a lot of different places. So great to be here, and hopefully happy to give you more insight on what we do.
Wonderful. Thank you so much. So one of the first things that I would like to talk about, and I'm interested in all of your perspectives on, is the very beginning of making an investment, maybe in let's just assume a hypothetical kind of promising new company. How much are you thinking about what exit looks like for that company, and how important is it to have kind of a range of exit opportunities, whether they're IPOs or sale to a larger firm or a private equity sale? How are you thinking through that even from the very beginning? And let's go back to Jay. We'll just go back down the line the other way.
Sure. So I don't know if this is the right answer, but I'll give you our perspective. We typically look at M&A as in some ways a downside protection, frankly, because whenever we underwrite a project, because of the nature of venture capital, it is truly a grand slam business, and so the very few key companies end up being the potential outliers of the overall portfolio. So hence, when there's an exit opportunity, that's amazing, but what we're looking for is the 1000x multiple of our money. So in specific to M&A, though, I would say that we've had a few cases where the M&A was just a very natural route, and I'll give you maybe the perspective of the reasons why M&A has happened in our portfolio over the last several years. We've had a couple of cases where the founders essentially reached a certain point of scale, and they were at in some ways an inflection point where they decided they could either raise further scalable capital, or they decided that perhaps the M&A value of where they've brought the company to was a life-changing event for them. So a lot of it is truly personalized. Like we have a company that we sold that was acquired several years ago called Frontier Car Group. Think of it as an international CarMax or Carvana. And the company was in multiple geographies in various countries throughout Latin America and Africa and whatnot. But they eventually got acquired by Naspers for about $700 million. And that was an amazing outcome for the founders and our multiple. We were the very first seed investors, and I think it ended up being about a 15x multiple for us. But the reality is that, if they did decide to take that company even further, who knows how big that company would have been. But, just to give you a perspective, that those are situations where we're very welcome. We let the founders decide ultimately where the natural exit route is. When we underwrite those projects, frankly, when we make a thesis, we're ideally looking not only for downside protection, but also what could go right. And naturally, an M&A might be the most natural route, which in many cases, a majority of our companies end up having those outcomes, and not so favorably like the Frontier Car Group, for example, where they're naturally either acquired by other companies and whatnot. So I share that as one data point.
I mean, I think we have a really similar perspective because I guess we do invest in pre-seed and seed. We don't underwrite for M&As. We usually go for IPO. Again, as Jay said, 1000x is what we're underwriting for. So less of an M&A or other path, we just go for IPO mostly. And again, M&A is more of a downside protection. But I used to be at a LP side, investing VC funds. That's when I underwrote some of the late stage companies or late stage VC funds that are investing in late stage companies. That's where we thought about, when they're investing in the late stage series C or D, then they think about M&A is a potential underwriting path or worst case. But at pre-seed and seed stage, we don't even think about M&A. Or if you're investing in private equity fund, then it's M&A by another private equity fund is another way to go. But yeah, for early stage VCs, it's mostly IPO or nothing.
Yeah, not much more to add. I think all of us understand that in venture, it's really, a few handful of companies that matter. And really that's what drives venture returns long run. That being said, having a robust M&A environment is still important. I think just as more outcomes for founders, I think it definitely impacts the founders we invest in more than anything. And then I would say, given that companies have the propensity to stay private for longer, there are blockbuster M&A deals that have, the rate of those deals going through has really suffered, I would say, in the last few years, with antitrust really tightening down. And, an example is, right, Figma's almost acquisition by Adobe. Like, those returns are extremely important for the venture ecosystem. Anything in sort of the $1 billion range plus is impactful to a fund's portfolio. So agree with everyone with the caveat that, late stage acquisitions still very important, and hopefully we'll see more of those in the coming years.
But that's really interesting. And I think, just sharing for a second my perspective on the side of either representing companies that are looking to buy venture-backed entities or venture-backed entities looking to sell to companies. One puzzle that we work out with regulators is the perspective of an antitrust regulator kind of in the US has been, but also in the UK and elsewhere, has been that, if a startup company has projected for itself, very strong growth, and then it doesn't really work out, that what antitrust should do is kind of prevent it from being acquired by maybe another competitor or an adjacent player in the space. Assuming that in the but-for world, that player, that startup company would just kind of continue to grow and eventually IPO into a major player. Now that, from my perspective, seems like quite a lot of pressure to put on every startup company that is out in the ecosystem. But, from your perspective, like, is that borne out by the data? Is that the right perspective for these regulators? And maybe carrying it a step further, right? If anytime you have a promising startup that doesn't quite make it, or considers their best option to be M&A rather than an IPO, would blocking that as kind of a matter of course under the antitrust laws drive innovation, which is the kind of hypothesis of at least the former antitrust administration in the US?
Can you answer I'm sorry, to repeat the question, please, because I'm trying to
There is absolutely no way I could repeat that question. So here's the idea, right? So I take a company into FTC, DOJ, and I say, they want to be acquired by this other larger company. And the FTC or DOJ says back to me, well, they can't be because they compete or there's a vertical relationship. And it's better for competition and innovation if this startup company remains on its own to grow into a major second competitor to the others in the industry. The hypothesis being, if they are not allowed to be acquired, that there will be more players in whatever market they're looking at. And I think for me, there's a question mark around that hypothesis, right? Is it really true that if a company is looking at M&A, that they were going to grow into some IPO'd player that would have been a major competitive force? And there's a second order question, which is, if in every one of those circumstances you block that transaction, where do VC dollars go as a result?
Yeah, I mean, I would say to you, the asset class of venture is also evolving, just to give you a big picture, because I think what even Vivian mentioned is companies are deciding to stay private longer. If you look at the top, 50 companies, and you look at the market value and the revenues, these are public companies, and you can essentially do a litmus test, just the fact that there's so much secondary trading activity on those private companies, like the Stripes of the world, and so I would say to you that my initial reaction is that we're always aware now that the timeline to a successful outcome, i.e. acquisition or a IPO listing, is very difficult these days. And so the rationale is how does the government and the regulators evaluate that? Because ultimately the macro environment is as such where we can't control some of those forces. I mean, you look at the interest rates and look at the administration. We're in a very volatile environment from a fundamentals perspective, and so the only thing that you can control, frankly, from the startup or the company perspective, is their ability to execute. And so, from a regular perspective, I would be thinking about how do you continue to have a balanced order of an economy that continues to thrive. If you chokehold that too much, it's one thing to have competition, healthy competition, and balancing the orders. It's another to really, I would say, curb innovation because of the regulatory climate. And I feel like in some cases right now, especially technology, that is being the case, with exception. And that's part of the reason why you're seeing, I don't know if it's because of the public environment, but a lot of companies that should be private are still kind of asking themselves, do they want to stay private? And if so, or is there possibly a more natural M&A alternative? And so those questions, frankly, I wish I had the crystal ball, because we have a lot of companies that are 10, 15 years old and would love to stir the pot and talk about M&A as a natural sort of remedy for them. But it just hasn't worked out that way. It's not so much linear. It's a little bit of a zigzag line. And you ask that question, in some ways, some of the topical questions around the antitrust and the regulatory sort of climate right now that these companies are dealing with.
So that's really helpful. And Ian, I would be interested in what you think. And I'm kind of naturally myopically focused on like US antitrust or global antitrust, but you're operating in kind of a very global landscape. Like how much is the regulatory environment and the kind of current state of regulatory environment, especially because it changes, political administration, political administration, affecting the way you think about investment, or affecting the way the companies you invest in kind of go to market and think about their growth?
So, I mean, for Korea, I think there's not much of an M&A market. That's why everybody's trying to come to the US, and that's why we help them. So there's a lot more opportunity for Korean companies or Korean American companies to be successful in the US market and go for NASDAQ. Korea, the market isn't big enough or there's some kind of different mentality that Korean companies or conglomerates or bigger companies don't really acquire small one. They actually try to create a similar technology or company like that. So it's a completely different environment. And that's something we talk a lot, that the innovation ecosystem in Korea is not growing as fast because there isn't enough liquidity for M&A. So once you can IPO, there's no way for VCs or founders to exit. So that just stops the money flows into the next generation of founders and type of stuff. And for the US, that's something that I think could have been or might be an extinction event for a lot of VCs here in Silicon Valley. I think we have new administration because of, a big push from the Silicon Valley VCs, which are not very politically active, to be honest, but they were really active for this time. I think it's because it's live or death situation for a lot of VCs for liquidity, because there's not enough IPO, not enough M&A. A lot of VCs were struggling to have, some DPI or give money back to their LPs. So that's where everybody got really active around the, election. And, it would have been, or I don't know how much it's going to change. We are hopeful that it's going to change in more M&A friendly or IPO friendly environment going forward, so that a lot of VCs can get their money back and survive. But yeah, I don't know. But on the other side, there were so much bubble in the VC ecosystem and startup ecosystem. So it's the right balance that we need. But the last 4 years was tough because you can't actually get any money out of your system, out of your portfolio companies or IP or M&A. But then at the same time, there are a lot of bubbles. So I don't know. We just need to find the right balance for this administration, I think.
That's great. Vivian, I'd be really interested to know if you have anything to add. And I'm also going to, since we're talking about tech, try to resolve my own technical difficulties while you weigh in. So I'm going to go off camera for 1 second.
Yeah, absolutely. I mean, it's such a tough line to walk. I think, selfishly, we'd love to see more M&A activity. We'd love to see more exits. Of course, that as Ian pointed out, is better for venture funds and for founders. I think it really incentivizes people to go out and start companies when they might see a clearer path towards exiting the company. And we've obviously seen a lot of companies in this post-COVID bubble, shut down without being able to find a home. And I think that's only going to become pronounced in the next few years. That being said, it is a fine line to draw because, I used to work at Uber. I was a PM there from 2013 on, and like had antitrust regulations not been in place and like we were allowed to acquire Lyft, I think I can see why these laws exist, or I can see why the administration and its policies exist for that reason. I think it is good and natural to have competition, but it's just about finding that fine line and not swinging too far one way or the other. And one could argue that there were a lot of, in my opinion, decisions from the DOJ in the last few years that did not make a ton of sense. And so I think it's just really finding that kind of fine line and maybe a more moderate view to it. But it's hard. It's going to be up to the new administration to kind of define what they want that to look like.
That's super helpful. And I guess maybe we'll come back to this for a minute, but I want to shift gears a little bit and try to think about, try to think about, and I know we're doing a whole founder panel, so we can talk about why founders do what they do in a minute, but from your perspective, right, you've got someone, assumes, someone, she's got a really great idea, new company, super innovative, what does that extremely innovative person do? Like, how do they decide between coming to you and seeking VC investment and starting their own thing and going for it versus going to one of the larger, more established tech firms and say, I'm super valuable, hire me and I will help you kind of capitalize my idea? Like, how does that decision work? How hard is that decision for someone with a good idea? And how do you kind of persuade them that they want to give it a shot with you as opposed to like the slightly safer, but probably more immediately lucrative path?
I can take a stab at this. So I don't think that founders are always people who thrive well in a big company environment. I think, a lot of times they hate the bureaucracy of being in a big company. They have a big idea. And actually, I think it's the best time in the world to go out and be a founder. There's so much capital in the Valley. I would actually argue that the risk is not that high to go out and try to raise money on your own. And I just think fundamentally, like somebody who wants to build something in a big company is not necessarily like the person who wants to go start something. I think they're like potentially archetypes of very different people. And these days, it's if you're a very talented operator, it's really not that hard to kind of raise money from VCs, pay yourself, a decent salary, but also have that potential upside of being a real equity owner as opposed to starting something within, a big company. So I think it's really like not wanting to be, in a lot of bureaucratic red tape. I think it's very unlikely that someone is going to start a huge company within Google. I think oftentimes, unless you're moving the needle for their balance sheet, it's not going to be important to them. And they're not going to devote a ton of resources to it. And, I think it's the freedom to evade that, setup. And then it's also just like, pure equity ownership. If you are a founder and it works, it's truly an incredible opportunity for wealth creation, and an ability to like really make an impact on the world.
Joe, do you have more you want to add on this point? What is the
Yeah, I mean,
the mind of a founder?
I can give you a little different perspective culturally. I think starting a company and also being in a larger organization, all very valid careers and opportunities. But if you look at the US, especially like Silicon Valley, and also compare it to other places around the globe, like Korea or Japan, historically, I mean, even in Korea, it was not a very practical thing to start a company. you would get disowned in some cases, right? So and even Japan, I think even Japan market is still that innovation culture. It's all about efficiency and manufacturing, and so that mindset is changing, I believe, and I think the world is becoming flatter for innovation. But technology, I mean, in terms of investing, you think about Silicon Valley and its special place. It fuels, it's almost a badge of honor, culturally speaking, to start a company. And so I believe that, for the right individual, I think it's just a matter of either they love that archetype of solving a problem, a personal pain point, or seeing an opportunity in the market, or they may be at a company and they decide that it could be better, faster, cheaper somewhere else. So there's so many different cases behind why a company or a founder decides to start. And so I think in some ways it's cultural as well as a personal one. And both are very valid, in my opinion.
So I want to turn in 1 second to Aquahires, but Ian, I want to give you an opportunity to weigh into unpacking the mentality of the founder.
No, I don't really have a lot to add. It's just the massive upside that you're going to get as a founder. I think that's just completely different environment. I mean, the upside is so much compared to what you get from Google. I mean, you get paid well there, but it's not going to be like you're going to be a billionaire next year. So I don't know. That's how I see it. And the other thing is, it's the, autonomy. Like, you can do whatever you want as a founder. VC is going to tell you and nag you from here and there. But at the end of the day, you're going to make your own decision, and you can start and working on your own pace. So I think it's very fun project for a lot of founders.
All right, can we talk about Aquahires for a minute? So there have been a number of pretty interesting transactions that have happened, and I mean, the Aquahires have been around forever, right? But there's been some ones getting headlines in the last couple of years, with some very large numbers attached. What do VCs think about Aquahires?
I mean, I think VCs think about Aquahire. I mean, I also was an LP who was investing in VC funds. I thought Aquahires were mostly a failure for that VC. I mean, you're going for 1,000x, now you got 2x. I mean, some people might brag that we got 2x in a year or two, but that's not what we're promised as an LP. And that's not what you're going for. The outcome is completely different from what you imagined when you first decided to invest in that company. I think there was one example, I don't want to say the name, but the VC was not really happy that he got 2.5x in a year and a half because he thought that company will be the next OpenAI. So I don't think Aquahires are very glorious exit for a lot of VCs.
Jay, why don't we go to you next, then back to Vivian, or we can go the other way. Whoever feels strongest should jump in first.
No, I mean, I would comment what Ian has mentioned. I think what we tend to do, especially in these cases where you have a very open, candid conversation with the founders, and you realize that for various reasons, the acquihire may be a more natural, ending for the company, or a next inflection point, is that we tend to let the founders decide, because ultimately you can't force a team to continue to go and see an opportunity that you might see that they don't, or they're not motivated to. So acquihires tend to be not the best economic outcome. I would say it can make great outcomes. Like, I've seen cases from a corporate perspective. Like, I'll give you a couple examples. Like the core team that built Google's kind of ad engine, that core team was acquired many years ago from a startup, and it was a very reasonable $200 million acquisition by Google, but it became the core of Google AdSense, right? And so that was a great outcome for the founders, because they stayed in the company, the team got acquired, and they kept their shares, and they all became billionaires. So in some ways that can work phenomenally. And even Twitter bought a couple of very interesting AI companies very early on, which became their kind of AI team. And those couple of individuals are very, very successful in as well as out as investors. So those outcomes can be great, you know, but it will fit the personality and in some ways the life stage of those founders and the corporates. For an investor standpoint, I have yet to see it becoming a great success story for us, frankly speaking, outside of, you know, some of the rounding errors that we see in our portfolio.
Yeah, I would say an Aquahire generally is never going to be a fund returner. It could be a nice exit for the founders who might get a great package, but typically, you know, for an investor, not the best outcome. An acquisition is probably a different story, but an Aquahire is usually, you know, they're buying the talent, and investors are not going to get much from that. So not much more to add there. I just would, maybe one more thing is, it's really important that there is a lot of alignment between you know, founders and investors. You know, it's really important that, like, if you raise venture capital and you're a founder, at least initially, you can always reserve the right to change your mind, but you know, your goal is to go for the big outcome. If your goal is to, you know, be acqui-hired or M&A early on, I would say then probably not a great idea to raise venture capital. And then you can go different routes of raising money, maybe bootstrapping, but it's just important that incentives be aligned so that there's no, you know, disagreement between both parties. But I think Jay's right. The founders are always going to do what's good for them, and we'll always support the founders that we back.
That's all really helpful. And I know my partner Brian is speaking on the panel following this, but I know that these types of transactions in particular have been a space where, as Latham has advised, kind of companies on all sides of early investment transactions and exits and everything else, right? There's been a lot of innovation, or Brian tells me there's been a lot of innovation in the space in terms of even how all these documents are drafted that have been kind of inspired by some of the changes in the environment. And, you know, to me, what's interesting about, I think that AI in particular, right, is just, in addition to building a good product or having a great idea or a kind of well-structured company with a good idea, the existence of these very bright, brilliant people within the ecosystem who are just so foundational, especially to the development of these new AI models, and we saw something similar in crypto, is really shaping, you know, from the M&A perspective in particular, just the way people talk about what the assets in a transaction are and where the value is. And so it's a funny thing to see intersect with antitrust, which kind of was formed around, you know, industrial, like it formed in the industrial age in terms of the way it thinks about companies and the way they interact with each other. And it's very unusual for an antitrust regulator to kind of be told and to hear, no, like, it's not important. Like, the thing they built, this company, is just an example, like a test case for how smart they are. Like, that thing, cool, but like not that valuable. But this person who figured that out, like, once I put them in the right place and they stop playing with their toys and play with my toys, like, amazing things are going to happen. And that is a kind of new way of thinking about industrial organization economics, which is at the foundation of antitrust, that I think is changing, at least in my world, the way we talk about all this stuff. So let me, because, you know, this is my space, let me change hands a little bit. I would like to talk a little bit about kind of the world of antitrust for a minute, and just your perspectives. We've gone through 4 years. We had Lena Khan. She's among other things, one of probably the greatest antitrust influencer since, I don't know, Sherman. And then we have a kind of a new administration coming in, and a shift to the Trump administration, although still probably a pretty regulatory forward administration with some different bents. Like, how was the last 4 years for you? Did this factor into your thinking at all? Are you thinking about what Trump 2.0 is going to look like for your companies and for your investments? Like, where are you at right now? Who wants to go? Let's go with Ian.
I mean, we don't really try to predict anything about regulatory changes. We actually want somebody, a founders who's going for any, you know, chance within the regulated area. because that's where the big outcome's going to come out. For example, Korea had a really big new type of bank toss. I mean, including myself, everybody said it's not going to fly because starting a bank in Korea is the hardest job to do, and they're doing really great. So that's one thing. And again, like, this is not something that we can predict. We invest in companies in pre-seed and seed, and it's going to take at least 7 or 8 years for the company to be large enough to think about this. So I don't know. And we also invest in some telehealth companies in Korea as well. And it's not allowed in Korea back then, but when COVID happened, and it was allowed, and the company did really, really well. So it was it's always very unpredictable. That being said, I think we're getting into less hostile environment in terms of liquidity or M&A and IPO. So we're more excited about it, but at the same time, we always have that kind of mindset that we can't predict how the regulation will change, how the administration will change, how the policies will affect us. We just try to find the best founder and back them.
Vivian, why don't we go back to you and then we'll go to Jay.
Sure. Not much more to add there. I don't think it's changed the way we invest at all. We want investors.
It would be very sad to hear that.
Yeah, it hasn't changed the way we invest at all. You know, whatever administration is in power, their policies, it's very much find the best people, big ideas, truly, you know, disruptive, and give those folks money. And again, like, the goal is for them to go big or go home, right? Like, become a public company. But I do think I am excited for there to be homes found, hopefully. Like, we'll see if the M&A environment picks up, but should there be less, you know, restrictions in place, I do think that there are companies that will not make it to standalone public entities, and like, it would be great for those founders to have an exit, find a home, and even great for VCs, not even from the returns front, because again, that doesn't really affect much, but also, like, sometimes it's better for those founders, frankly, to find something else to do with their lives. And I think M&A really will provide an avenue for people to have still a good return for the work that they've put in, and find a home and move on.
That's really helpful. Jay, anything you want to add on this one?
Well, I'll just add, you know, everyone is currently, especially with AI, up in arms around the DeepSeek, you know, China controversy, right? So I can bring that in to bear. And you think about, you know, the Trump administration right now, and I think even at his inauguration, I've never seen so many of the Silicon Valley heavyweights sitting there basically kissing the ring. And fundamentally, what I mean by that is I think it's going to be a very top-down regime where, you know, on one hand, I can see it being very favorable for pro-capitalist friendly industries, which is majority, and that driving a lot of I call it friendly policies, whether it be for AI or whether it be for crypto, whether it be for key sectors. And so the way I think about an investor is that you just don't want to be on the other side of it. And as an example, from a antitrust, whether that be even, I'll give you an example, like one of our companies, they built automation software to help with work visas. That whole space completely got obliterated during the first Trump administration. That company got acquired by a large conglomerate because there was no way to fight the immigration policies in the first administration. So I think that we're very well aware of what's going on, you know, and you have to take, you know, I think especially with Trump right now, frankly speaking, that he's going to put his hands in a lot of different places, or try to. And the reality is innovation can either be in favor or not in favor, depending on where you sit in this next 4 years. And so as far as I can tell, you know, we're underwriting for the next 10 years. So hopefully, you know, these companies have a chance to navigate all the antitrust and all the regulatory policies that will be evolving in real time. But, you know, a startup is a startup. You know, we underwrite for the next 18 to 24 months, ideally, and then those companies shift and they have to raise more capital. So you hope that those material milestones, that those companies have a chance to to drive that and the next generation, AI company that become hopefully the Metas of the world and the Microsoft of the world. But it is all, you have to really take all that into account, frankly speaking, now. I think more so than ever. So it does impact us when we underwrite things.
Yep. That's really helpful. And Ian, I have a slightly different question for you, because I know you do a lot of investment that touches Korea. Do you have anything in the back of your mind that you're focused on in terms of trade policy or concerns or things that you wish you could, if you could walk up to regulators in any country you want and make your voice heard, what would you tell them?
I don't think there's a lot of things that we can talk to the US regulators. We try to move the Korean companies to the US because there's so much regulation in Korea. It's hard to get the money out, money in. I mean, money in is easy, but get the money out of Korea is really hard. And there are a lot of different, laws and regulations that we don't like in Korea. And we think that's actually stopping Korean companies become bigger. So that's where we see a lot of opportunities, some arbitrage that we can bring some great Korean talent, Korean companies to the US, to the Silicon Valley, and help them become one of the US companies. So, I mean, we think this is a better environment than Korea for sure.
Yeah. That's a fascinating perspective, right? Though that what you've found is you've got a place with a lot of talent, but kind of a very challenging path to growth and monetization.
Right.
And the solution is to move them to kind of a less regulatory environment. And it's an interesting perspective because, we've gone through, at least in my world, a pretty regulation heavy cycle. But to hear you say that, all else equal, it's preferable in this space is pretty interesting.
Right. Yeah, that's exactly why we think there's a lot of opportunities here. And even better for the next 4 years.
So I wanted to talk a little bit, so hopping off of trade policy and thinking about, so one trend we are seeing, and this is drawing from some experience I have in terms of operating in Europe and in the UK, is we probably spent, half a decade seeing pretty aggressive regulation out of especially tech regulation out of Europe and UK. And there's antitrust, but there's also things like the Digital Markets Act and some AI, really out of the gate AI regulations that came out. And a reaction that kind of shifted, I think, probably counterintuitively, even more investment kind of towards the US, where I think the point was to regulate US companies operating in Europe. And now we've seen a kind of a complete shift, right? A focus. I mean, the UK CMA leadership just changed over. Leadership changed over at the Bureau of Competition in Europe, but a renewed focus on creating an environment for investment in Europe. With that in mind, like, are there, and I know you're all focused on your own kind of spaces, but are there optimal conditions for investment and innovation and VC investment in an economy that you would look for or would be optimal, right? If you were to walk into some European nation today and say, if you want more investment in this country, here is what I would do. I'll let you think about it for a second because it's a hard question. Anybody want to jump in?
I mean, unless they make it as US, I don't think there's any way for me to go to that. It's just, I mean, there's regulation for sure. I mean, Europe has more regulation than the US for sure, but then it's also about the market size and how heterogeneous the entire continent is. Like US and I think China are the two only homogeneous market that we can get into expecting 1000x. So Europe, I mean, it's good and I love visiting Europe, but then at the same time, there's changing the regulation will be hard. Even if they do, it's just not big of a market size. Yeah.
Yeah, I mean, we are actually a global firm and we have offices in both Europe and Israel. I think, though, that even across that portfolio, we've had the best success. And oftentimes we'll see, as Ian alluded to, it's tough to kind of sell into that market alone. Unless maybe you're building a consumer product. We've seen some great, tech consumer products built in Europe and Latin America. huge success stories in fintech and others in kind of both places. But I think for what we focus on, which is really kind of B2B and enterprise software and infra, really we would, we're okay with teams building in other countries, and sometimes that can be an advantage, much lower cost of labor. But at the end of the day, I would still say that there usually needs to be a path for those companies to sell into US-based customers as well. And then we often see a lot of those companies open up sales, go to market, and then eventually even product in like tech offices in the US. And it's kind of hard to fight that pool, that gravitational pull. And I would say today too, with a lot of AI and research-based talent in certain clusters, and it's hard to resist that pull. So tough, I think, in kind of B2B and enterprise world to not sell to the US.
Jay, do you have anything you'd like to add on this one?
No, I mean, I would say, having spent a number of years with a firm that does a lot of work overseas, through the transatlantic, I would say that the couple of things that are hard to change, and it can change. I mean, the short answer, when you asked about what would you advise as being able to, when is the best time in some ways to start a company, this is the very best time, because this is another technology wave happening, which is AI, and we're literally seeing the railroads being built right now in front of us, and now you're going to see all these applied AI applications and incumbents and others and disruptors coming about. So, but for Europe in particular and other, I think the biggest thing is, in our small world of venture capital has a cycle, and the cycle is that the thing that needs to happen is you have to have great entrepreneurs that build great companies. You have to have a great funding ecosystem and a support network, and that's all there across the globe, in particular Europe. I think the thing that's lacking possibly in Europe is just exit, and the mindset that there's a liquidity sort of cycle that returns capital back into the cycle, into the innovation cycle. And so that, even globally right now in the US, we're in kind of a headwinds environment where there's really no IPOs just yet in the last few years. So if you think about everywhere else, I mean, everyone's looking at the US as kind of a pole position sort of player. And so that's one area that if you can apply a macro view to it, there's got to be better ways to recycle capital through the system. And then also just like even timelines, I think even culturally speaking, for venture capital, venture is a very long, illiquid, it's the most illiquid asset class. And so, you have companies now in their 14, 15-year sort of journey. And I would say a lot of Europe, and not to say everyone, but a lot of European investors across the fold, the LPs in particular, there's a very fixed timeline, sub 10 years, like a sub private equity style type of investor, where you have to generate a certain percentage of DPI at a certain year. And that just doesn't fly in venture, frankly speaking, when you're in year 15 and you have to sell your positions. And those are some of the regulatory hurdles you have to sort of solve for innovation to truly foster, because everything is interconnected, from the entrepreneurs to the venture investors at the end of the day. And so that cycle has to be unstuck in some ways. So hopefully that that gives you some perspective. It can't be solved overnight, but I think those are a couple of things that I would highlight.
That's really helpful. So I am gonna let, mostly because this is the longest I've ever been in the same virtual space with Danny and not heard him speak. So I'm certain he's got some questions he'd like to ask. So I'm gonna let him jump in just to make sure he's okay.
Thanks. I'll mix it up just a little bit. To a certain extent, when you're venture people, you think about deploying assets and you think about deploying financial assets, but I want to talk about redeploying human assets. And it's something that you touched on earlier, which is if companies are basically stuck, can't quite sell, are not going to be able to go to IPO, you have a lot of really talented individuals who would be much better off starting their next company. You've probably worked with a number of serial founders. And I wonder if you could just talk about the importance of serial founders and your relationships with them, and why they also like to build, sell, go back to build, because I think this part of the mindset is oftentimes lost in policy circles.
I think,
Ian, sorry.
yeah, I think we usually try to find a founder who's going to be a serial founder, to be honest. I personally try to find the younger founders and then try to bet on them. Even if they fail, I don't care. I'm going to back them again. And the companies get stuck. I mean, we're trying to help them find, a buyer or some other type of exits. But at the same time, we're not going to blame them. We're just going to encourage them to start a new company. And another exciting part, I think that we have a lot of serial founders in our portfolio companies, and some of them try to do venture capital because they thought it'd be fun, but most of them actually go back to founding another company. I think they just enjoy building a new company and building their own thing. So I think that those are the founders that we're really excited about. And then I agree, like if a company gets stuck, I mean, we have to make a hard decision. We usually try to just, let the founder decide what they want to do. We are happy to write it off. Again, especially us, pre-seed and seed investors, one deal, I think we're targeting for 50% or 60% survival rate. So at least 40% of companies that we invest will be zero. So I think that's how we think about investment as a venture capitalist, especially us as seed and pre-seed investors. And then we try to allocate the better human resource at a better project, at a bigger project as much as possible.
Jay?
I have a slightly maybe different perspective. I would say that we love founders that are constantly constantly curious. And a lot of founders, it's an incredibly long journey to start a company and to be successful at it. And most of the times, your very first couple fail, or several iterations. So that in some ways it's almost a badge of honor. Now, having said that, we have on the flip side, we have entrepreneurs who are very successful that have sold or gone IPO, and they come back again. And on that example, we actually question whether they're the right entrepreneurs to back again. And a lot of it is driven by, is this founder hungry enough because they've done so well? And, in some ways, the data is out that it's not obvious that those successful founders make even more successful, because if you have a big company that you've been, part of, and you started it, now having said that, Silicon Valley, just in that perspective, it's a very special place. It's one of the places where it's a very healthy, paid forward mindset, where you could see billionaires walking around Birkenstocks, you never know it. And it's sort of that mindset of redeploying the human assets back in, and doing it faster, better, and cheaper, right? So that is in some ways a central node of the culture. But yeah, I mean, I would say that we always tend to ask the question around motivation, and does this founder, in terms of the functional skill sets, are they curious? Are they willing to learn? Are they willing to move quickly? Have a sense of all those fundamental checkboxes have to make out in order for us to consider, a repeat or entrepreneur and a team.
We actually really love second, third time founders here at Next 47. I mean, we love, first time founders as well. And I think a good mix of that is great, even in one's portfolio, where, you have the younger teams that might have fresh new insight. They're oftentimes very scrappy, hungry, like the motivation is clearly there. I think to go out and start a business again is no small feat. Like it's, if you've had a great exit, it's still difficult to commit yourself to being a founder and running a business again. And I think that commitment alone is often enough justification for kind of wanting to give this person another shot again. We're looking at, and I think, the best second time founders are maybe one who had like a smaller exit the first time around, maybe not enough to get them so comfortable, but this is like their big one. Or like maybe you had a sub $100 million exit, but this is your chance to create, your IPO company, your legacy. And I think we see a lot of that, and that's quite exciting. I think it's hard to say which archetype of founder is better. The data is mixed. I think that's why it's great to have both. It's great to work with both, and kind of pros and cons with each. And, with a seasoned founder, it is great. Like they have already learned all those first time mistakes, and they know exactly what to do, how to hire a team, like what not to do. First time founders will make those mistakes all over, and may require a little bit more handholding, a little bit more help on your front. So I think a mix of them is good. But in general, I think starting a company is just so difficult that to sign up for that all over again is a good sign that they're in it. But hear all sides as well.
Hey Daniel, I can give you one story really quick that's interesting, and I'll just share this with you because it's one of our more successful companies that's at this pre-IPO stage. It's a company that Ian mentioned. It's one of our companies in the early stage called Toss. It's one of the fastest growing fintech companies out of Korea. And to give you the founder story, I mean, this was before starting Toss. And so give you some Toss is like a super app fintech company. It's got a bank, securities. I mean, it's like Robinhood plus Chime plus everything built into one. Very successful. It creates the largest. And the founder, before starting Toss, he failed almost 5 or 6 times before starting the company. To show you the grit and the tenacity. And even before that, before going to startups, he was a dentist, just to give you kind of how different of a journey. And so even you think about him mentioning he's switching to starting startups to his parents culturally. I mean that was almost like personal suicide in many ways, right? But you just see these stories, and those are the kinds of stories that we get up in the morning, we get motivated by, because these are the special entrepreneurs that relentlessly come back up, and they look for something and a problem to solve. And even though they may hit the snags in the road and they have multiple failures, they use that as a way to build bigger, greater. And that company now is about an $8 billion value company and pre-IPO. So you just never know, frankly speaking. And in many ways, it is one of those like unique kind of fairy tale stories of of grit and using a lot of your experiences to your advantage, right?
So I'm can't help but ask you, is it not an accident that toss rhymes with floss?
Maybe that's actually no one's ever mentioned that, but
I'd like a follow-up email.
Yeah, well, the
confirming
corporate
my
name
this
is
right.
nothing to do with toss or dentistry. It's called Viva Republica, which is that's the corporate name. The product name is called Toss, but maybe that was the inspiration during one of his late nights with one of his patients.
So I just wanted to, I think, and unless anybody would like to throw in any concluding comments, I think this has been a really enjoyable discussion. And I know Ian had a pressing thing he needed to get to, but Ian, Vivian, Jay, it's been great to talk with you all. Thank you so much for spending some time with us. It's been really wonderful.
Thank you.
Thank you.